Hello everyone, this is Sanjali, and in today's video, we shall discuss the different financial ratios that would be useful in the fundamental analysis. So, firstly, let us start with the meaning of a ratio. So, ratio is basically a comparison between two or more components in uh, a financial statement. सो फाइनेंशियल रेशो एक ऐसा रेशो है जिससे कंपनी की फाइनेंशियल इन्फॉर्मेशन जानी जा सकती है और इसी इन्फॉर्मेशन को कंपैरिजन पर्पस के लिए यूज़ किया जा सकता है. सो बेसिकली ये रेशो इन्वेस्टर्स और मेनली बिजनेसेस को हेल्प करता है उनके इंडस्ट्री या उनके सिमिलर बिजनेस के कंपैरिजन के लिए. Now let us talk about the different types of ratios. So basically there are 6 categories of financial ratios that business manager normally use in their analysis, and within these 6 categories there are 13 financial ratios that help a business manager and outside investor analyze the financial health of the firm. So in this video particularly we shall talk about the first two types. The first is liquidity ratio and the second is solvency ratio. So these ratios are only valuable if there is a basis of comparison for them. So each ratio should be compared to the past time period of data for the business, and they can also be compared to data for other companies in the industry. Let's begin with the first type, which is liquidity ratios. So firstly, what is liquidity? सो अगर हम बात करें लिक्विडिटी की तो इट इज़ द एबिलिटी to convert the assets into cash quickly, and they are most useful when they are used in a comparative form. So liquidity ratios are an important class of financial matrices used to determine a debtor's ability to pay off its current debt obligations. So the higher the liquidity ratio, the more likely is the company to pay its short term liabilities. Now, under liquidity ratio, the first and the most important ratio is current ratio. तो अगर हम definition की बात करें तो the current ratio measures a company's ability to pay off its current liabilities which are payable within 1 year with its total current assets such as cash, accounts receivable and inventories. Here if we see the formula of current ratio is current assets upon current liabilities. So firstly we need to understand the difference between current assets and current liabilities. So what are current assets? Current assets are the assets that can easily be converted to cash within a year, and current liabilities are the liabilities or the debts that are payable within a year. If we talk about the examples of current assets, it includes cash and cash equivalents. Like, for example, there are any bank deposits in the current account, then various accounts receivables, or the inventory. It includes raw material, work in progress, and the finished goods as well. Also, the short term loans. So, all these things come under current assets. अब अगर हम बात करें एग्जाम्पल्स की करंट लाइबिलिटीज़ के अंदर, तो इट इंक्लूड्स अकाउंट्स पेबल. सो इसमें सप्लायर्स आते हैं. सो जैसे अगर हम किसी सप्लायर से अगर हमने क्रेडिट लिया है, लाइक फॉर एग्जांपल इफ़ द क्रेडिट पीरियड इज़ 3 months और 4 months, then it becomes our current liability. Then it also includes outstanding expenses and cash credit as well. So if the current ratio is 2:1, it means that the company has assets more than its liabilities and it is an ideal ratio. But if suppose the current ratio is say 0.8:1, it indicates that the company is not in a condition to pay its short term liabilities. So the current asset should always be greater than its liabilities. Now the next liquidity ratio is quick ratio, and the definition says that it is an indicator of a company's short term liquidity position and measures a company's ability to meet its short term obligations with its most liquid assets. Now this ratio is quite similar to current ratio, but the only difference is that the current assets do not consist of inventories and these are quick assets. So the formula is quick ratio is equal to current assets minus inventories upon current liabilities. So the current assets here exclude the inventories and they are known as quick assets. So the higher the ratio, the better a company's liquidity and financial health. And the lower the ratio, the more likely the company will struggle with paying its debts. Now we are done with liquidity ratios. The second main category of ratio is solvency ratio. So now first of all, what is solvency? Solvency क्या है? तो solvency is the ability of a company to meet its debt and other financial obligations. So, solvency and liquidity ratios both measure a company's financial health, but solvency ratios have a longer term outlook than liquidity ratios. So, solvency ratio liquidity ratio से ज़्यादा accurate है बोल सकते हैं. Now, this is the first type of solvency ratio, which is debt to equity, and it measures the company's debt relative to the value of its net assets. So, all big investors or analysts check this ratio before investing in order to make sure that there are no chances of the company to go bankrupt, which means that the company is solvent. And if we talk about the ideal ratio, so it should be less than 1, and a higher ratio indicates a company or a stock with higher risk to shareholders. The formula for debt to equity ratio is total liabilities upon the total shareholders equity. Now let us take a small example. I've taken this snapshot from the annual report of Naveen Fluorine. So if we check the total liabilities, they are 26,359.19, and the total equity against it is 1,63,390.68. So if we calculate the debt to equity ratio, it comes to 0.16, which is less than 1, and we can interpret that the company is quite solvent and it is able to pay off its debt in the future. Okay, now moving to the next solvency ratio, that is interest coverage ratio. So, to define in simple words, the interest coverage ratio is a debt and profitability ratio used to determine how easily a company can pay its interest on its outstanding debt. And the interest coverage ratio is calculated by dividing the company's earnings before interest and taxes by its interest expense during a given period. So, generally, a higher coverage ratio is better, although the ideal ratio may change from industry to industry. The lower the ratio, the more the company is burdened by debt expenses and the less capital it has to use in other ways. So, when a company's interest coverage ratio is only say 1.5 or lower, its ability to meet interest expenses may be questionable. So, analyzing this ratio over time will give a clear picture of the company's financial position. I hope you liked today's video. If you did, do like, share, and subscribe to our channel, and also hit the bell icon to get more video updates. You can also follow us on Instagram to stay in touch. This is Sanjali from UA Capital. Your investment journey starts here.